before we get started, I'd like to address a few housekeeping matters. To earn CP credit for this session, you must attend for at least 15 minutes and respond to a minimum of 3 of our 4 polling questions, which will appear on your media player at various points throughout the presentation. In addition, you'll have the opportunity to submit questions using the Ask a Question box that you should see in your media player, and we'll respond to questions towards the end of today's presentation. There will be a short survey at the end of the presentation to complete and submit it, and also we will send you a recording of the webinar and follow-up email. So here we go, we'll get started. Our theme for implementing the new standard is bridging the gap, which recognizes that there has been an existing lease standard for over 40 years now. First challenge in implementing the new standard is understanding exactly what has changed. The new standard, which is a complete rewrite rather than a markup of the existing standard, weighs in at nearly 500 pages when you consider the standard itself, implementation guidance, basis for conclusions, and conforming changes to other areas of GAAP. Reading through this and comparing it to the existing standards to tease out the changes has been a time-consuming but necessary process. While much has remained the same, there are a number of differences, some quite obvious and others rather subtle. The devil really is in the details on this one. Today we plan to share with you our understanding of those changes, which we hope will enable you to bridge the gap as a starting point for a successful lease accounting implementation. Our agenda for today begins with an overview of the new leasing standards with a focus on the impact to the amounts and presentations in the financial statement. We'll then consider accounting matters that are common to both the lessor and lessee. We will then focus on the lessee accounting model, followed by the lessor model. And following this, we will discuss the effective dates and transition provisions, an understanding of which is key to an effective implementation plan. And finally, we'll discuss the enhanced disclosure requirements under the new standard. After today's training, you'll have a high-level understanding of the new lease standard and be able to differentiate between the current and the new lease requirements. And with that, I'll now turn the presentation to Jim, who will begin our overview of the new lease accounting standard. And our first polling question will be towards the end of this section.
Thanks, Katie. The new standard was issued in February 2016 and was codified as Topic 842 and will fully replace existing GAAP codified as Topic 840. There were long-standing requests dating back over a decade from users and other interested parties to change the accounting requirements for operating leases. The core principle of the new standard is that operating leases should be reflected on the lessee's balance sheet. Most users of financial statements already make adjustments to put leases on balance sheet. Those adjustments are often based on limited information, frequently overstating the liability. Other users of financial statements are unable to make such adjustments when using data aggregators or screening tools. By placing operating leases on balance sheet, there will be less emphasis on structuring leases to qualify as operating leases. This was typically done by structuring the present value of the lease payments to be just under 90% of the fair value of the lease item. Leases still make sense economically because lessees want to manage residual value risk, or they want to transfer risk of ownership during the lease period, or they do not want to have rights to use all of an asset. This slide is an overview of the accounting models for both lessors and lessees. The biggest change from Topic 840 is highlighted in gray. Operating leases will be accounted for by recognizing an asset representing the right of use of that asset under a lease and an offsetting liability representing the obligation to make lease payments over the lease term. The asset is referred to as a right of use asset, and the liability, a lease liability. The right of use asset and lease liability is initially recognized in an amount equal to the present value of the future lease payments. The liability is considered an operating liability rather than debt. The primary difference between a lessee finance lease and an operating lease is the recognition and presentation of lease expense. For a finance lease, interest expense, a non-operating expense, is separately presented from the amortization of the right-of-use asset, an operating expense. For an operating lease, the accretion of the lease liability and the amortization of the right-of-use asset are presented as a single lease expense within operating expenses. This approach results in the front-loading of lease costs for finance leases, as interest expense is greater in the early years, as opposed to operating leases, which the lease cost is even over the lease term. Lessor capital leases are classified as either sales type or direct financing lease. Both approaches derecognize the leased asset and record the net investment in the lease at its present value. Interest income is accreted on the net investment in the lease. The primary difference in accounting is that selling profit on a direct finance lease is deferred and amortized over the lease term. There are also differences in the treatment of indirect costs. Lessor operating leases continue to be off-balance sheet in the sense that the future lease payments are not recognized as a receivable. However, the leased asset remains on the lessor's balance sheet. The right-of-use asset is considered a non-financial asset and is subject to impairment under Topic 360, Disposal of Long-Lived Assets. For the lessor, the net investment in the lease is a financial asset and is assessed for impairment under Topic 310, Receivables. When determining the loss allowance, the collateral relating to the net investment in the lease should be taken into consideration, which represents the cash flows from the asset during the remaining lease term, sale, or lease. The biggest difference between U.S. GAAP and international financial reporting standards relates to lessee classification. Under IFRS, there is only one lessee classification, and it is accounted for similar to a finance lease under U.S. GAAP. This is a bridge of the accounting model for lessees. For lessee financial statements, the only significant change in presentation is that operating leases are now on balance sheet. Changes to the classification criteria are discussed later. This is a bridge of the accounting model for lessors. For lessor financial statements, the only significant change in presentation is the treatment of selling loss, which Topic 842 specifically requires to be recognized up front. However, there are changes to the classification criteria which will likely result in some leases currently classified as direct financing leases being classified as sales type leases. These changes are also discussed later. This slide highlights significant areas of change between Topic 840 and Topic 842. We have already touched on changes resulting in the on-balance sheet accounting for operating leases. Other changes include Topic 842 provides a new definition of a lease that is more principles-based than Topic 840, which has a more prescriptive, rules-based definition. Changes to the classification criteria include removal of bright lines and quantitative thresholds, although these will likely continue in practice, and elimination of separate classification criteria for real estate leases. Under Topic 842, the classification date and lease accounting date is the commencement date of the lease, as opposed to the inception date under Topic 840. Topic 840 contains specific guidance on whether a sale-leaseback transaction should be recorded as a sale, effectively providing guidance independent of the existing guidance on revenue recognition. Under Topic 842, the guidance in the new revenue recognition standard, Topic 606, is applicable when determining whether a sale-leaseback qualifies as a sale, thus avoiding potentially duplicative and conflicting guidance between the leases standard and the revenue standard. Disclosure requirements have been enhanced for both lessees and lessors. Leveraged lease accounting has been eliminated, which applies to certain structured transactions that involve borrowing against the lease asset. However, the accounting for existing leveraged leases has been grandfathered. In addition, the FASB considered various approaches that would have changed the lessor accounting model, but decided not to make significant changes to the lessor model. However, changes do exist, and changes to the definition of a lease apply to both lessors and lessees. Lessor accounting is also aligned with the new revenue recognition standard, topic 606. It's now time for Katie to present our first polling question.
For our first polling question, true or false, operating leases are on balance sheet with a right of use asset and a lease liability. You'll have 30 seconds to respond to the question, and remember for CPE credit, you need to respond to at least 3 of the 4 polling questions. Just a few more seconds, and we'll close out the question. The correct answer is true. Under the new standard, operating leases will be recognized on the balance sheet with a right of use asset and a lease liability. So Jim will now take us through some general considerations for lessors and lessees, including the definition of a lease, scope exceptions, the definition of lease payments, separating components of a contract, the lease term, incremental borrowing rate, initial direct costs and remeasurements. And the second polling question, again, will be at the end of this section.
A contract may legally or economically be a lease, but may not meet the definition of a lease within the scope of topic 842. If not a lease for accounting purposes, the contract might be the purchase of an asset or an executory or service contract. The definition of a lease under topic 842 is principles-based, while the definition under topic 840 is more prescriptive. The topic 842 and topic 840 definitions of a lease both focus on the control of property, plant, and equipment. However, control is defined differently under the 2 topics. Topic 840 provided specific examples of control, some of which focus on the right to operate or control access to the asset, and others that focus on the amount of output taken by the lessee. For instance, under topic 840, the lease existed where the lessee has the ability or right to operate the asset in a manner it determines while obtaining or controlling more than a minor amount of its output or utility. Under topic 842, the customer must have the right to substantially all of the economic benefit, not more than a minor amount. Embedded leases, in particular, are more likely to change definition under the new standard. However, we believe that most contracts that meet the definition of a lease under topic 840 will continue to meet the definition of a lease under topic 842. The period of time under topic 842 may be described in terms of the amount of use of an identified asset, such as the number of production units. An identified asset is explicitly specified in a contract or implicitly specified at the time the asset is made available for use. An asset might be implicitly specified when the contract specifies the product brand and model, but not the serial number, but the serial number becomes known when the product is delivered. An identified asset does not exist if the supplier has a substantive right to substitute the asset throughout the period of use. The right is substantive only if the supplier has the practical ability to substitute alternative assets throughout the period of use and would benefit economically doing so. Definition of an identified asset is largely unchanged from topic 840, although a capacity portion only needed to be for more than a minor amount of the output under topic 840, while it must be for substantially all of the output of an asset in order to be a lease under topic 842. This slide provides a high-level decision tree to be used in evaluating whether a contract contains a lease. The first criteria to be met is whether the contract is for an identified asset. Second criteria is whether the customer has the right to obtain substantially all of the economic benefit of the use of the identified asset throughout the period of use. The third criteria is that the customer must have the right to direct how and for what purpose the asset is used throughout the period of use. If neither the customer nor the supplier has such right, then how and for what purpose is predetermined. If how and for what purpose the asset will be used is predetermined, then the contract will be a lease if one of two criteria are met. The customer has the right to operate the asset without the supplier having the right to change those operating instructions, or the customer designed the asset that predetermines how and for what purpose it will be used. The scope exceptions listed are not exhaustive. The definition of a lease refers to control of plant, property, and equipment. Therefore, anything that is leased that is not plant, property, or equipment is outside the scope of Topic 842. There is no conceptual basis for excluding leases of intangible assets from the scope of Topic 842. The FASB preferred to wait for a comprehensive review of the accounting for intangible assets rather than deal with issues like leases on a piecemeal basis. It would be difficult for an asset under construction to meet the new definition of a lease. Pieces of inventory would be difficult to define and are not common. There are other topics in GAAP that deal with natural resources, biological assets, and service concession arrangements. There is an important elective scope exception to exclude short-term leases, which have a lease term of 12 months or less, and do not include a purchase option that is reasonably certain to be exercised. Lease term is based on the definition in Topic 842, which would include optional periods that are reasonably certain to be exercised. The election applies a class of underlying assets to which the right of use relates. Lease payments define the amounts to be included in lease assets and liabilities on a present value basis for both lessors and lessees, with the exception of amounts owed on residual value guarantees, which are only included by the lessee. However, the lessor also includes residual value guarantees and the unguaranteed residual value in the net investment of the lease. The payments are largely consistent with Topic 840. The first exposure draft would have required the inclusion of an estimate of all variable lease payments based on probability-weighted outcomes. However, the FASB ultimately decided that such estimates would not be reliable and would otherwise be burdensome for preparers to calculate. Note that the fixed payments are the payments due over the lease term, which in some cases will include optional lease periods. The lease term is discussed further in the presentation. First step in separating components of a contract is to identify lease and non-lease components based on the definition of a lease. The second step is to determine the contract consideration. For the lessee, this includes the lease payments and the following payments not included in lease payments: any fixed payments, such as monthly service charges, plus any incentives paid to lessees, and variable payments dependent on a rate or an index that are essentially fixed. For the lessor, this includes the same amounts the lessee would include, but also includes variable amounts, other than those that pertain to a lease, that would be included in the transaction price in accordance with the guidance on variable consideration in Topic 606. The third step is to allocate the contract consideration to each separate lease and non-lease component. Lessees allocate using a relative standalone price for each component. The standalone price is based on the observable price a supplier or similar supplier sells similar lease and non-lease components on a standalone basis. If there is no observable price, then the price is estimated maximizing the use of observable information. accounting policy election, the lessee may not separate the lease and non-lease components of the contract, but account for them as a single lease component. This election must be made a class of underlying asset. The lease term includes the non-cancelable period of use, periods related to renewal options that are reasonably certain to be exercised, periods under termination options that are not reasonably certain to be exercised, and renewal option periods controlled by the lessor. The non-cancelable period cannot extend beyond the contractual term, which ends in a situation where both the lessor and lessee have termination options without significant penalty. The differences between Topic 840 and Topic 842 on lease term are small but subtle. All renewal options that are reasonably certain of exercise are included in Topic 842. Under Topic 840, specific types of renewal options are specified, all of which would indicate the option is reasonably likely to be exercised. However, Topic 840 does not cover every option scenario. Treatment of termination options is not specifically addressed in Topic 840. However, a termination option can act in the same manner as a renewal option, so the conditions that apply to specific renewal options will also apply to a termination option. The term reasonably certain in Topic 842 was intended to equate to reasonably assured in Topic 840. Reasonably certain considers all economic factors relevant: contract-based, asset-based, market-based, and entity-based factors. This slide addresses the definition of the incremental borrowing rate. The definition under Topic 842 is the rate of interest the lessee would have to pay to borrow on a collateralized basis over a similar lease term, an amount equal to the lease payments in a similar economic environment. The new definition requires the use of a collateralized or secured rate. Cost of money is not an appropriate rate. In some cases, it might be reasonable for a subsidiary to use a parent entity or group's incremental borrowing rate as the discount rate. Initial direct costs are incremental costs of a lease that would not have been incurred if the lease has not been obtained. They can be capitalized as part of the lease asset by both the lessor and lessee. Topic 842 excludes costs that are not incremental, such as general and administrative costs. It also excludes costs that would have been incurred regardless of whether the parties execute the lease, such as costs to negotiate an unsuccessful leasing transaction. This slide addresses situations when the lease asset and liability should be remeasured subsequent to its initial recognition. In all cases, the lease classification should be reassessed. For each remeasurement event, the elements to be updated are indicated on the matrix. A lease modification is treated as a separate contract when the lessee is granted an additional right of use not included in the original lease, and lease payments increase commensurate with the standalone price for the additional right of use. If a lease is modified, that modification is not accounted for as a separate contract. The classification, reassessment, and remeasurement is performed as of the effective date of the modification. A remeasurement event that relates to the change in likelihood of renewal of purchase option exercise occurs when there is a triggering event. A triggering event is any of the following: a significant event or a significant change in circumstances that is within the control of the lessee that directly affects whether the lessee is reasonably certain to exercise or not exercise an option, or an event in the contract that obliges the lessee to exercise or not exercise, or the lessee ultimately exercises an option that was not deemed certain of exercise, or the lessee ultimately elects not to exercise an option that was originally deemed certain of exercise. Another remeasurement event relates to variable payments becoming fixed. Contingency upon which some or all of the variable lease payments are based is resolved since those payments now meet the definition of lease payments. For example, an event occurs that results in variable lease payments that were linked to the performance or use of the underlying asset becoming fixed payments for the remainder of the lease term. It's now time for our second polling question.
Thanks, Jen. I do want to acknowledge and apologize that we're having some issues with the presentation mode, but we are in the process of trying to fix that and working on it. So as we wrap up the section on general considerations for lessors and lessees, the second polling question should be up. So on January 1st, a co-working center rents 100 square feet of office space to a lessee for $1,000 per month. The lessor has many suitable office spaces available to let. The location of the office space will not be determined until March 15th. Is there a lease contract in place at January 1st? So again, you'll have 30 seconds to respond to the polling question. We're getting ready to close up that question. And as a reminder, you do have the opportunity to ask a question by clicking on the box and submitting. So the correct answer to the polling question is no, because there is not an identified asset until March 15th. Moving into the next section, Jim will now cover the lessee accounting model, including lease classification and measurement.
The lessee classification model requires finance lease classification if one or more of 5 criteria are met. These include the transfer of ownership test, the lessee purchase option test, the lease term test, the present value test, and the alternative use test. If none of the criteria are met, the lease is accounted for as an operating lease. Transfer of ownership test does not apply if the commencement date of the lease falls at or near the end of the economic life of the underlying asset. The lease term and present value tests under Topic 840 had a similar late in life exception. However, under Topic 842, the exception only applies to the lease term test. Reasonably certain under the purchase option test is considered comparable to reasonably assured criteria in Topic 840. FASB implementation guidance indicates that one reasonable approach to defining major part in the lease term test is to use 75%, and 90% would be a reasonable approach to defining substantially all the present value test. These suggested percentages are comparable to the bright line thresholds in Topic 840. This slide presents a bridge between the lessee classification criteria Topic 840 and Topic 842. Two biggest changes are the addition of the alternative use test to the classification criteria for finance leases, which were previously referred to as capital leases, and the elimination of special considerations for real estate leases. The alternative use test, which is a criteria under the current IFRS standard, has been added to the classification criteria. As already discussed, there are also changes to the bright lines within the criteria. The initial measurement of the lease liability and right-of-use asset is the same for finance leases and operating leases. The lease liability is equal to the present value of the unpaid lease payments, which we defined on slide 21. The present value is determined using the implicit rate in the lease, or the lessee's incremental borrowing rate if the implied rate is not known. Determining the implicit rate requires knowing the fair value of the leased item at the date of purchase and its residual value. Residual value may be difficult to determine. Therefore, we expect that many companies will use their incremental borrowing rate, which was discussed on slide 24. The right-of-use asset is comprised of an amount equal to the lease liability on a positive basis plus initial direct costs incurred plus any prepaid lease payments, less any lease incentives received. This slide addresses the subsequent measurement of the lease liability and right-of-use asset. The lease liability is always equal to the present value of the unpaid lease payments, regardless of whether the lease is a finance lease or an operating lease. For finance leases, the right-of-use asset is equal to the beginning right-of-use asset, less accumulated amortization, less any impairment losses recognized. Amortization is generally calculated on a straight-line basis. For operating leases, the right-of-use asset is equal to the carrying value of the lease liability, plus the balance of unamortized initial direct costs, which are generally amortized on a straight-line basis over the lease term, plus or minus any prepaid or accrued lease payments, plus unamortized lease incentives received, which are generally amortized over the lease term. The measurement basis for an operating lease results in periodic lease expense equal to the total lease cost being recognized over the lease term on a straight-line basis. Total lease cost includes the lease payments, initial direct costs, plus any incentives received. The measurement basis for a finance lease results in the front-loading of lease expense, as interest expense is higher earlier in the life of the lease. An example of the measurement of both a finance and operating lease is included in the appendices for your future reference. These calculations provide a proof to the measurement model presented on this slide. Now turn to the lessor accounting model, including lease classification and measurement. This slide presents the first part of the lessor classification model. The lessor classification model requires sales type lease classification if one or more of 5 criteria are met. These are the same criteria as for the lessee test. The implementation guidance previously discussed for lessees that addresses interpreting major part, substantially all, and reasonably certain also apply to lessor classification. Like the lessee classification test, the transfer of ownership test does not apply if the commencement date of the lease falls at or near the end of the economic life of the underlying asset. If none of the 5 criteria are met, then the lease is not classified as a sales type lease, and further analysis is required under Part 2 of the lessor classification model. Part 2 of the lessor classification model requires direct finance lease classification if 2 criteria are met: a revised present value test and a collectibility test. Unlike Part 1 of the classification test, the present value test in Part 2 includes any residual value guarantees by third parties unrelated to the lessor, thus making it more likely that the present value criteria will be met. If the criteria is met, the lease is classified as an operating lease. This slide presents a bridge between the lessor classification criteria, topic 840, and topic 842. The biggest difference relates to the criteria that distinguishes a sales type lease from a direct finance lease. Under topic 840, the only distinction related to whether a lease gave rise to a manufacturer's or dealer's profit or loss, in which case the lease was classified as a sales type lease. As discussed on the previous slides, the distinction now largely turns on the inclusion or exclusion of third-party residual value guarantees, the present value test, as well as the collectibility test. As is the case for the lessee classification model, an alternative use test was added to Part 1 of the lessor classification model. Topic 840 includes a no uncertain cost criteria, whereby there could be no important uncertainties surrounding the amount of unreimbursable costs yet to be incurred by the lessor under the lease. This criteria has been eliminated under topic 842. In addition, there are no special considerations for real estate leases under topic 842. And finally, leveraged lease accounting has been eliminated, although the accounting under topic 840 is grandfathered. existing leverage leases. The initial measurement of the net investment in the lease is the same for sales type and direct financing leases, with the exception that selling profit is deferred as a reduction of the net investment for direct financing leases. Otherwise, the net investment in the lease is equal to the present value of future lease payments and residual value guaranteed. Present value is determined using the implicit rate in the lease. There is no possibility to use the incremental borrowing rate as there is for the lessee. Subsequent lessor accounting follows an amortization schedule approach, whereby the net investment in the lease is increased for interest income and reduced for the collection of lease payments. Income statement recognition includes interest income, variable lease payments not included in the net investment of the lease, less any impairment of the net investment recognized in accordance with the impairment guidance in topic 10. Katie will now present the third polling question.
So for our third polling question, under the new lease accounting standard, selling profit is deferred and amortized for leases classified and accounted for as direct financing leases. Is true or false? And you have 30 seconds to respond. We're getting ready to close out this polling question. There will be one more later in the presentation. And the correct answer is true. Selling profit is deferred and amortized for leases classified and accounted for as direct financing leases. Selling profit is recognized up front for sales type leases. We will now discuss the effective dates and transition provisions for topic 842 and the key decisions that each entity will need to make as part of its implementation.
Thanks, Katie. For calendar year-end public reporting entities, topic 842 is effective January 1st, 2019. The transition provisions of topic 842 must be applied to the beginning of the earliest period presented. Therefore, for year-end public reporting entities, date of initial application is January 1st, 2017. For a year-end public reporting entity, generally the earliest balance sheet presented in accordance with topic 842 will be December 31st, 2018. The earliest income statement presented in topic 842 applied will be the full year ended December 31st, 2017. Selected financial data table in Form 10K is not required to be restated in periods prior to the date of initial application. Prior periods presented must be restated by using a modified retrospective approach for all leases that exist at the date of initial application or commence during the comparative period but prior to the effective date. Full retrospective approach is not permitted. Full retrospective approach would have applied topic 842 since the commencement date of the lease, which could be many years before the date of initial application. Topic 842 specifies multiple different transition models. Which model is applicable to a particular lease depends on how the lease classification changes or does not change between topic 842 and topic 840. For example, a lease originally classified as a sales type lease under topic 840, subsequently classified as an operating lease under topic 842, will follow a different transition model than a lease classified as an operating lease under both topic 840 and topic 842. Each model follows a modified retrospective approach that defines the balance sheet accounting, the date of initial application, and the subsequent accounting for the lease. Since lessee operating leases have the biggest balance sheet impact upon transition and will impact the most organizations, we will provide an overview of the transition model leases classified as operating leases under both topic 840 and topic 842. That model requires the initial recognition of the lease liability, equal to the present value of the remaining lease payments as defined under topic 840, with amounts probable of being owed by the lessee for any residual value guarantees. Discount rate is established at the latter of the earliest period presented for the lease commencement date, not the original date of the lease. Right of use asset is measured in the same way that it would be under topic 842. Initial direct costs that do not meet the revised definition under topic 842 are written off as a reduction of equity. This model results in a transition balance that is similar to what the balance would have been at topic 842 that applied since the original commencement date of the lease. However, it is also different in that it applies the definition of lease payments under topic 840 and does not use a discount rate established at the commencement date of the lease, unless the lease was entered into between the date of initial application and the effective date. An example of transition accounting for an operating lease is included in Appendix 4. This example reflects the use of practical expedients, which we will now discuss. There are certain practical expedients which, if chosen, will significantly reduce the burden of implementation. They apply to leases which commence before the effective date and are outstanding as of or after the date of initial application. If elected, the practical expedients must be applied to all leases of an entity, whether the entity is acting as lessor or lessee. There are certain practical expedients that essentially grandfather the accounting under topic 840 and must be taken as a group. These expedients are not reassessing whether a contract meets the definition of a lease, not assessing classification under topic 842, and not assessing whether initial direct costs meet the definition of topic 842. Whether or not an entity elects the package of expedients, the entity may use hindsight when determining the remaining lease term, whether a lessee purchase option will be exercised, whether the right of use asset is impaired. In addition, sales leaseback accounting is not reconsidered. The package of practical expedients is chosen, which we expect most entities will do. The entity will continue to account for existing leases in accordance with topic 840, with the significant exception that operating leases will be on balance sheet. However, after the effective date, lessees apply the reassessment criteria as there is a remeasurement of the lease is subsequently accounted for under topic 842. In addition, on or after the effective date, the lease is modified and not accounted for as a new contract, the lease will be accounted for under topic 842. We'll now turn to the enhanced disclosure requirements under the new standard. But first, the final polling question will be at the end of this section. This slide presents the general requirements for presenting lease amounts on the face of the balance sheet. A lessee should present the lease right of use asset and liability either on the face of the balance sheet or the notes of the financial statements in a manner that identifies which line items in the balance sheet contain the assets and liabilities. Right of use assets and lease liabilities are subject to the same considerations as other non-financial assets and financial liabilities, classifying them as current and non-current classified balance sheets. Finance leases, interest expense on the lease liability, and amortization of the right of use asset are not required to be presented as separate line items. It should be presented in a manner consistent with how the entity presents other interest expense or amortization on similar assets. Operating lease payments are presented in operating cash flows, plus those payments represent costs to bring another asset to the condition and the location necessary for its intended use. The lessor may present the net investment in the lease, aggregate, sales type, and direct finance lease. The lessor shall present any profit or loss on the lease recognized at the commencement date in a manner that best reflects the lessor's business model. The lessor uses leases as an alternative means of realizing value from the goods that it would otherwise cost of sales relating to his leasing activities, separate line items, so that income and expenses from sold and leased items are presented consistently. The lessor uses leases for the purpose of providing finance. The lessor shall present the profit and loss as a single line item. The objective of the lease disclosure requirements is to enable users of financial statements to assess the amount, timing, and uncertainty of cash flows arising from leases. Therefore, the required disclosures are not intended to be exhaustive. Lessee disclosures should generally be distinguished between finance and operating leases. Lessees and lessors should disclose information on the nature of its leases, including information related to variable lease payments, options to extend or terminate, residual value guarantees, and any restrictions or covenants imposed. Significant judgments should be disclosed, such as the determination as to whether a contract contains a lease, allocation of consideration between lease and non-lease components, and a determination of the discount rate. Use of practical expedients should be disclosed, such as not separating non-lease components from minimum lease payments, and an election of the short-term lease exemption. Maturity analysis of gross future minimum lease payments, though required, must be reconciled to the balance sheet amounts, which are on a present value basis. Related party leases should also be disclosed. Sale leaseback transaction disclosures should include the terms and conditions of the transaction and any gains or losses arising from the transaction, separately from gains or losses and disposal of corporate assets. This slide presents the requirements for lessees to disclose components of its net lease costs broken down between finance and operating leases. This slide presents other lessee quantitative disclosures. Note the new requirements to disclose the weighted average remaining lease term and discount rate separately from finance and operating leases. Generally, disclosures for lessors of operating leases remain largely unchanged under the new standard, although more qualitative disclosures are required. Components of the net investment in the lease are disclosed on a net present value basis. This will require entities to perform separate amortization calculations for each component of the net investment in the lease. It is now time for our fourth and final polling question.
Thanks, Jim. So this is our last polling question. Lease classification criteria remain largely unchanged from current GAAP. However, what is the one new lease classification criterion for both lessees and lessors? A, the substantive use test. B, lease term test. C, alternate use test. You have 30 seconds to respond to this last polling question. Get ready to wrap this up. And the correct answer is C, the alternate use test. Before we answer questions that have come in throughout the presentation, let's just recap some of the major points that we covered today. All lessee operating leases will be on the balance sheet, with a right-of-use asset and a lease liability recorded. There is a new alternative use test to the lease classification criteria for both lessors and lessees. There's a narrower definition of initial direct costs. For direct finance leases, recognize losses upfront and defer gains. There are no longer special rules for real estate leases. And leverage lease accounting has been eliminated with grandfathered for existing leverage leases. If you've not already done so, if you'd like to submit questions, please do that now. And we will cover a few that have come through throughout the presentation here. Okay. So for the first one, As a lessee, how do you assess and evaluate the right-of-use asset for impairment?
Right. So a lessee will follow impairment guidance topic 360. So you would essentially treat the right-of-use asset similar to how it would evaluate plant, property, and equipment for impairment. If you're the lessor, however, would follow the impairment guidance topic 310 on receivables. So you would look to, you'd probably do a collateralized analysis. You would look to the underlying leased asset, in terms of what the collateral value is, what would the cash flows be from selling or releasing that asset in terms of evaluating.
Another question that came through is, how is the collectibility test similar or different between topic 840 and topic 842?
Well, in topic 840, to be a sales type lease or a direct finance lease, both of those classifications required that these payments meet the collectibility test. So even if you met all the other criteria, the collectibility test, these will be classified as an operating lease. Under 842, collectibility is only relevant for the classification of a lease as direct finance lease, no longer relevant to the sales type lease classification. However, for sales type lease, you still need to consider collectibility when you're measuring the asset, because consider that connection with the impairment guidance.
And this last question that came in relates to lessor disclosure. Components of the net investment in the lease are now required to be disclosed on a net present value basis. Do you expect this to be an issue for companies?
Well, companies may have to make systems changes to decompose the net investment in the lease into its components on a present value basis. It's really only done at one level today. We actually have a good example in appendices where we laid out the calculations from a lessor perspective, the lease under 840 and 842. You can actually see the additional calculations involved.
I think that is everything that has come through.
One more question? I make an accounting change. How does current account? How does the new standard make more sense? Well, it really is. The overriding reason was getting operating leases on balance sheet. That has been discussed probably for the last 20 years at least. In the sense that there was lack of comparability between entities that entered into operating leases that were off balance sheet. Their leverage wasn't comparable to entities that outright purchased assets or financed them with direct financing. That was really the driving force. In doing that, they took a holistic look at the standard and really kind of cleaned up a lot of aspects of it. Remember, this standard was written 40 years ago. The way they wrote the standards 40 years ago was very less conceptual than it is today. So in some respects, there was a lot of housekeeping and reconsideration of other aspects. But at the end of the day, the benefit is to the user of financial statements in terms of making balance sheets comparable between all types of entities that engage in leasing activities.
This concludes our webinar for today. Again, I do want to apologize for some of the malfunctions that came through within the presentation. And I want to thank you for your attendance. Please be on the lookout for an invitation to our follow-up webinar on the operational implications of implementing the new lease standard. And if you've met the requirements, you'll receive your CPE certificate along with a copy of the presentation, which includes the appendices that Jim referenced throughout the presentation, and that'll be sent in an email within a few days. So thanks again, and have a great day.